Good morning, students. So let us start video 3 of module 2, Finance and Taxation, Accounting and Auditing. In this video, we will concentrate on 3 topics: features of income tax, residential status, incidence of tax. So let us start with features of income tax. So the very first one is Central Act. Income tax is charged by central government on all income other than agriculture income. Second, direct tax. Income tax is a direct tax. The person who earns income is liable to pay the tax. He cannot shift the burden of tax to others. Third, tax on income. It is a tax on the income of the person. The income consists of salary income, house property income, business or profession income, capital gains, and other source of income. Annual tax. Income tax is chargeable in the assessment year at the rates prescribed in the Finance Act for that year. Tax on person. The charge is on every person who is liable to pay the tax. Person include any individual, Hindu undivided family, company, partnership firm, association of persons, body of individual, local authority, or any artificial legal person. Tax liability. A person becomes liable to tax as soon as any taxable event has happened in his case. The taxable event means when taxable income has accrued or been received by him. The tax liability come into existence in the previous year and assessed in the relevant assessment year. Rates of taxes. The rate of taxes increase with increase in the income of person. Administration. The income tax is administered by the Central Board of Direct Taxes, which is called as CBDT, under the Ministry of Finance. The CBDT exercise overall control over the income tax in accordance with the provisions of Income Tax Act. Applicability. The Income Tax Act applies to whole India, including Jammu and Kashmir. Next topic, we are starting residential status. Tax is charged on the income of assessee. Under Income Tax Act 1961, the total income of every person is computed based upon his or her residential status. For the purpose of determining the residential status, assessee are classified into the following categories: individual, Hindu undivided family, which is called as HUF, firms, companies, any other person. So the very first, we are starting the residential status of an individual. It refers to the status of an individual which is determined on the basis of his or her total stay in India. Under Section 6, the residential status of an individual is divided into two categories: resident and non-resident. A person is a resident if the person fulfill at least one basic condition. And after fulfilling at least one basic condition, the resident can be resident and ordinarily resident, and the second can be resident but not ordinarily resident. A resident, if he or she fulfill both additional conditions, then that resident is called as resident and ordinarily resident. If a resident is not fulfilling additional conditions or fulfilling only one additional condition, then that resident is called as resident but not ordinarily resident. The basic condition is contained under Section 6, subsection 1, which says that number 1, stay in India for 182 days or more in the previous year. Number 2, stay in India for 60 days or more in the previous year plus 365 days or more in 4 previous year preceding the previous year. Additional condition is contained under section 6 subsection 6, which says that number 1, resident in India for 2 years out of 10 previous years preceding the previous year. Number 2, stay in India for 730 days or more during 7 previous years preceding the previous year. Next, residential status of HUF. HUF is Hindu undivided family. A Hindu undivided family may be resident but not ordinarily resident or non-resident. For determination of residential status of HUF, there is one basic condition and two additional conditions. Basic condition, these conditions say if the place of control and management of HUF is wholly or partially in India during the relevant previous year, then HUF is resident. If the place of control and management is wholly outside India, then HUF is non-resident. The place of control and management means the place where head and brain of HUF business resides. It means the decision-making affair is situated in India. The place of business can be different from the place of its control and management. A resident HUF will be ordinarily resident only when Karta satisfy both the additional conditions. So the additional conditions are number 1, Karta has been resident in India for at least 2 previous year of immediately preceding 10 previous year relevant to the current previous year. Number 2, Karta has been in India for 730 days or more during 7 years preceding the relevant previous year. So when can an HUF is not ordinarily resident? So when a resident HUF is not ordinarily resident in India, if its Karta doesn't satisfy both or any one of the additional conditions. And when can HUF is non-resident? If the control and management of its affair is situated wholly outside India during the relevant previous year. Next, residential status of firm. Residential status of firm AOP and BOI is contained under section 6 subsection 2. A firm or AOP. AOP means association of person, can be either resident or non-resident. It cannot be resident but not ordinarily resident. So a firm and association of person will be resident in India in any previous year if the place of control and management of its affair is wholly or partially in India in that year. It will be non-resident if the place of control and management of its affair is wholly outside India during that year. Residential status of companies. Residential status of companies is contained under section 6 subsection 3. A company can be either resident or non-resident. A company will be resident if it satisfies either of the following two conditions in any previous year. Number 1, if it is an Indian company on the basis of its incorporation or registration, its place of effective management in India during the relevant previous year. For this purpose, the place of effective management means a place where key management and commercial decisions that are necessary for the conduct of business are made. A company shall be non-resident whose control and management is situated wholly or partially outside India during the relevant previous year. If it is not resident during the relevant previous year, the provision of resident and ordinary resident but not ordinarily resident are not applicable on the company. Residential status of any other person. Residential status of any other person is similar to the partnership form. or AOP, and the provision of this is contained under section 6 subsection 2. Next topic, incidence of tax. Tax is levied on total income of a person. The total income is based on the residential status of an assessee. Section 5 provides the scope of total income which vary on the basis of status. So there can be two types of incomes, Indian income and foreign income. Indian income, if any of the following is positive, then it is an Indian income. Number one, if any income is received in India during the previous year, at the same time it accrue also in India during the previous year. Number two, if any income is received in India during the previous year but it arise outside India during the previous year. Number third, if income is received outside India during the previous year but it arise or deemed to arise in India during the previous year, then that income is called as the Indian income. Indian income is taxable in the hands of ordinarily resident. It is taxable in the hands of not ordinarily resident. It is taxable in the hands of non-resident. Second is foreign income. If any of the following two conditions are not satisfied, then such income is foreign income. And foreign income is taxable in the hands of only ordinarily resident. It is not taxable in the hands of not ordinarily resident and non-resident. So foreign income means any income earned or deemed to be earned and received both outside India, or any income earned received outside India from a business which is controlled and profession which is set up outside India. Apart from these two concepts, there are two other concepts also, which is called as controlled income also and exempted income. So controlled income is the income which is earned and received outside India from a business which is controlled and profession set up in India. Income may or may not remitted to India, that is immaterial, but the business should be controlled from India. That income is called as controlled income. And controlled income is taxable in the hands of ordinarily resident and not ordinarily resident. It is not taxable in the hands of non-resident. One more concept is there which is called as exempted income. So there are certain incomes which are exempted from the taxation. For example, any past untaxed foreign income which is brought into India during the relevant previous year. Or for example, share of the profit from HUF. So all these are the exempted income. It is not taxable in any of the cases of resident. So resident who is ordinarily resident and the resident who is not ordinarily resident and non-resident, all these three kinds of the residents are not liable to the pay tax on the exempted incomes. Next is agriculture income, which is one of the exempted income. So agriculture income means any rent or revenue which is derived from a land situated in India and used for the agriculture purpose. So, or any rent or revenue received from the house property which is situated in the immediate vicinity of agricultural land and used for the resident of the owner and tenant, or for storing the agriculture equipments. Or any income which is derived from ordinarily manufacturing activity concerned with agriculture and carried out by the agriculturist himself. For example, income from growing and selling of wheat, flour, trees, insurance money received for destruction of agricultural products, income from sale of dry tobacco leaves, income from sale of straw, income from growing and maintaining the nursery tea leaves. But there are some of the examples where the income is not agricultural income, like income from sale of trees, grass of spontaneous growth, income of salt produced by flooding the land with seawater, interest received by money lender in the form of agricultural produce, income from butter and cheese making, income from fishing, income from dairy farming, dividend received from a company engaged in the agriculture operations. So all these incomes are non-agricultural income. If we talk about their taxation part, then agricultural income is totally exempted from taxation under section 10 subsection 1. But in case of agricultural income from land situated outside India, it will be fully taxable under the head other sources. The next concept is capital and revenue. For income tax purpose, a clear understanding of difference between the two is essential because income tax is charged on revenue income, not on capital income, unless they are expressed taxable. Again, difference between the two is important because only revenue expenses are allowed and capital expenses are disallowed. So capital and revenue concept is divided into three parts: capital and revenue receipts, capital and revenue expenditure, capital and revenue losses. So let us start with the very first, capital and revenue receipts. Capital receipts are non recurring in nature and do not arise in the day to day activities of the business. On the other hand, revenue receipts are recurring in nature and arise during the ordinary course of business. And if I talk about their examples, so the examples of capital receipts are compensation received for nationalization, premium on issue of new shares, annuity received under LIC scheme, compensation received from employer for premature termination of service, insurance received for the loss of capital asset, compensation received for termination of agency before the expiry of stipulated period. So all these are the various examples of capital receipts. Capital revenue receipts. Revenue receipts examples are annuity received periodically, compensation received for loss of profit, proceeds of sale of forest trees, damages received for breach of contract, dividend and interest from investment, GST collected from purchaser, compensation received for the injury suffered in an accident, money received as a consideration for not resigning a directorship, money received by a tire manufacturing company for sale of technical know-how regarding manufacture of tire. So all these are the examples of revenue receipts. Next, capital and revenue expenditure. Capital expenditure is the funds used by a company to acquire and upgrade physical assets. For example, land and building, plant and machinery, furniture and fixtures. On the other hand, any maintenance cost to physical assets owned by the company is called as revenue expenditure. So, various examples of capital expenditure and revenue expenditures are: first, capital expenditure, cost of acquisition and installation of fixed assets. Any expenditure incurred for the purpose of increasing the earning capacity, amount paid as commission to purchase machinery, cost of reconstructing of a business building, brokerage paid for raising capital. So, all these are the examples of capital expenditure. Revenue expenditure, expenditure incurred in raising loan, a reward given to employee in consideration of his goods service, brokerage paid for raising loan for the purpose of business, legal expenses in connection with resolving winding up petition by the shareholder, amount received on the sale of security by the investment company, interest on loan. So all these are the examples of the revenue expenditure. Now come to the capital and the revenue losses. So the difference between these two is important because revenue losses are allowed and capital losses are disallowed. Like loss on sale of office furniture, loss of debentures at discount price, these are the examples of capital losses. So loss incur on account of embezzlement done by an employee, bad debts, these are the examples of revenue losses. So revenue losses arise in the course of regular business. Loss on sale of trading asset is one of the revenue loss. So capital losses do not arise in the course of regular business. So these are the various examples and the meaning of capital and revenue losses. Now let us learn some of the examples of incidence of tax. Number one, income from salary in Japan. So it is a foreign income. Second, interest on bonds of central government of India. So it is Indian income. Taxable income from house property in Rajasthan. So it is an Indian income. Dividend on shares from foreign company. That is foreign income. Income from agriculture land situated in Karnataka. So it is an exempted income. Interest received from a firm in UK, that is United Kingdom, remitted to India. So that is the foreign income. Payment from public provident fund, that is exempted income. Commission received in India for the services given in Nepal, that is Indian income. Profit of the business situated in Nepal brought to India, that is foreign income. Amount brought to India out of the past untaxed profits earned in Japan, that is exempted income. Share of income from Hindu undivided family is again an exempted income. Let us see more examples of incidence of tax. Like income from business from Mumbai, it is Indian income. Profit from business in US controlled from India, it is a controlled income. Income from house property in Japan received there, that is foreign income. Interest earned on post office savings bank, that is Indian income. Gift in cash from father again is a exempted income. Now let us discuss some of the examples of capital and revenue. Amount paid as commission to purchase of machinery is a capital expenditure. Cost of reconstructing of a business building is again a capital expenditure. Brokerage paid for raising loan for the purpose of business is a revenue expenditure. Legal expenses in connection with the resolving winding up petition by shareholders is a revenue expenditure. Brokerage paid for raising the capital is a capital expenditure. Expenses incurred on acquisition of copyrights by a publisher is a capital expenditure. Amount received on the sale of securities by an investment company is a revenue expenditure. Interest on loan is a revenue expenditure. Any amount received as a premium on hiring out some of the shops is a capital expenditure. Sale tax collected from the purchaser or customer is a revenue receipt. Bonus shares received by a dealer of shares is a revenue receipt. Annuity received is a revenue receipt. Commission received from the employer for premature termination of service, again a capital receipt. So bonus shares received by a dealer of shares is a revenue receipt. Compensation received for nationalization is a capital receipt. Dividend and interest from investment is a revenue receipt. So in this way, these are the various examples of capital and revenue. Exempted income, which is not a farm, which do not forms a part of the total income. So this is fully exempted. income which is fully exempted from income tax do not forms a part of total income of the assessee. If the assessee wish to claim any exemption under the Act, the burden of proof is that income is exempted from tax rest with the assessee, not with the income tax authorities. So the various kinds of the exempted incomes are contained under section 10. One income I have already explained to you, that is agricultural income, which is exempted income. It is not taxable in any case, whether a person is resident, whether a person is non-resident, whether the person is resident and ordinarily resident, whether a person is resident but not ordinarily resident. In any of the case, exempted income is not taxable. So all the exempted income is contained under section 10 subsection 1. So 10 subsection 1 is agriculture income. 10 subsection 2 is amount received by a member of Hindu undivided family from the income of Hindu undivided family is also a exempted income. 10 subsection 5 leave travel concession. 10 subsection 6 is salary received by an individual who is not a citizen of India. 10 subsection 8a, that is income of a consultant. 10 subsection 10 is gratuity. 10 subsection 10a is commuted value of pension received. 10 subsection 10 double A, income received as leave encashment on retirement. 10 subsection 10b, retrenchment compensation paid to workmen. 10 subsection 10c, retirement compensation from a public sector company or any other company. 10 subsection 11, payment from statutory provident fund. 10 subsection 12 is payment from recognized provident fund. 10 subsection 13 is payment from superannuation fund. 10 subsection 13a is house rent allowance. 10 subsection 16 is scholarship. 10 subsection 17 is allowances of MP, MLA, MLC. 10 subsection 17a, awards instituted by the government. 10 subsection 18 is a pension received by a certain winner of gallantry awards. 10 subsection 19 is a family pension received by family members of armed forces including paramilitary forces. 10 subsection 19a, income from one place of a former ruler. 10 subsection 20 is income of a local authority. 10 subsection 21 is an income of research association. 10 subsection 23b is income of institutions established for the development of khadi and village industries. 10 subsection 23bb, income of state level khadi village industries board. 10 subsection 23bbA is income of certain authorities set up to manage religious and charitable institutions. Section 1023BB is income of European Economic Community. Section 1023BBC is the income of SARC funds for regional projects. Section 1023BBE, any income of Insurance Regulatory and Development Authority. Section 1023C, any income received by a person on behalf of the following funds. So these funds like the Prime Minister National Relief Fund, Prime Minister Promotion of Folk Arts, Prime Minister Aids to Student Funds, all these kinds of funds comes under this section. So these are the various exempted income which is not taxable in India. So with this we have learned various taxation principles and various taxation terms which is related with the residential status and the feature of tax, capital revenue, different kinds of the income, that is Indian income, foreign income, exempted income, and various examples also we have learnt in detail related to incidence of tax and capital and revenue. Hope this video is very helpful for you and you have learned all the concepts in detail. Thank you everyone for watching this video.